Inside the safest market on Earth sits a trade worth more than $1 trillion that most investors have never heard of. It doesn't bet on interest rates going up. It doesn't bet on them going down. It bets on two prices of the exact same government bond drifting a few cents closer together. The profit on each bond is tiny, so the funds running it borrow again and again until tiny becomes enormous. Researchers at the Federal Reserve Bank of Chicago estimate the short leg of this trade at over $1 trillion in notional value. When it runs smoothly, nobody notices it exists. When it unwinds, the market that prices every mortgage, every corporate loan, and every government on Earth starts to seize up. This is the Treasury basis trade. Here is how the machine actually works. Why should you care about a hedge fund arbitrage? Because US Treasuries are the collateral of the global financial system. Pension funds, banks, and central banks all treat them as the thing you can always sell. When the basis trade is running calmly, it quietly adds demand for government debt and knits the cash, futures, and repo markets together. When it unwinds, it can turn a safe haven moment into a fire sale. That is what official reviews say happened in March 2020, when even treasuries were being dumped for cash and the Federal Reserve had to step in with purchases measured in the hundreds of billions to restore order. The Fed's financial stability reports now track this trade as a standing vulnerability. Same trade, two regimes. To see which regime matters, you first need to see the two prices at the heart of it. Every Treasury bond effectively has two prices. One is the cash market, where the actual bond trades. The other is the futures market, where contracts promise delivery of that bond later. Asset managers love futures because they get bond exposure without paying full price up front. Chicago Fed research shows their long futures positions have recently eclipsed $1 trillion in notional value. All that steady buying tends to make futures trades slightly rich compared to the underlying bonds. On the other side stand hedge funds, many of them domiciled in the Cayman Islands. Federal Reserve researchers tracking the cross-border trail found these funds had built holdings of about $1.85 trillion of treasuries by the end of 2024, financed with repo borrowing that reached roughly $2.5 trillion, roughly doubling in 2 years. That gap between the two prices is called the basis. Harvesting it is the trade. Here is the Lego version. Step 1. Buy the cheaper cash bond. Step 2. Short the richer futures contract against it. At expiry, the two prices converge and the trade collects the gap. That gap is pennies per bond, so step 3 is where the real machine lives, the repo market. The fund pledges the bond it just bought as collateral, borrows cash against it overnight, and uses that cash to buy more bonds. Then it rolls that loan every single day. Dallas Fed economists estimate hedge fund net repo borrowing reached roughly $1.8 trillion by the end of 2025, about 6% of all marketable Treasury notes and bonds. Regulators have also noted that much of this borrowing happens with zero haircut, meaning lenders demand no margin cushion at all. The loop feeds itself. Convergence pays, repo expands, positions grow, and the margin for error gets thinner. So what happens when the loop is forced to run backward? March 2020 is the case study. As the pandemic hit, investors everywhere rushed to raise cash. Treasury prices swung violently, futures exchanges raised margins, and repo funding got harder to roll. Basis positions that earned pennies in calm markets began losing serious money, and the unwind meant selling the very bonds the whole world wanted to be able to sell. A leveraged trade built on the safe asset amplified the dysfunction of the safe asset itself, and the Federal Reserve restored order by buying treasuries at a pace measured in hundreds of billions within weeks. Congressional researchers still cite that episode as the template for what Treasury market disruption looks like. Fed researchers asked publicly in 2023 whether the basis trade was back. It was. By 2025, official estimates suggested it had grown beyond its earlier peaks, which is exactly why the monitoring never stopped. So what do you do with this? Nothing to trade, something to see. The basis trade is neither villain nor charity. It stitches together three markets: cash treasuries, futures, and repo. Stress in any one of them now travels through the others. The things worth watching are repo rates, futures positioning data that regulators publish, and a big structural change on the calendar: the SEC's central clearing mandate, which is set to push much of this activity through clearinghouses and could reshape the economics of the whole trade. None of this predicts the next move in bonds. It tells you where the leverage lives and which pipes it flows through when markets get loud. That is a lens, not a signal. This channel explains how markets work. It is educational content, not financial advice.